While the West was watching football highlights and scrolling through their phones last night, something was happening on the other side of the world that most retail investors will only find out about when they wake up Monday morning and wonder why silver is already moving. Sunday, March 8th, New York time. Comment your date below so I can see where you're watching from. If you value this work, subscribe and comment George Williams. It really helps. Now let's get into it, because this Monday is not a regular Monday in the silver market. The setup going into this week is one of the cleanest I've seen in months, and if you're not paying attention right now, you are going to be the person buying after the move has already happened. Asia does not wait for you. Shanghai does not wait for New York to wake up and give permission. The buying happens in the dark, quietly, systematically, and by the time the COMEX opens and the American trader sits down with his coffee, the bid is already in. That is the game. That has always been the game. And this Monday, that dynamic is front and center. Silver is sitting at $85.29 per ounce right now. Let that number sink in for a second. $85. A year ago, that price would have sounded like a prediction from someone wearing a tinfoil hat on the internet. Today, it is the spot price. And what's more interesting than the number itself is where it's sitting within the range silver has been carving out all of early March. From $80 on the low end to $89 on the high end, silver has been coiling, compressing, finding its footing. That kind of consolidation after a major move doesn't typically end quietly. It ends with a breakout in one direction, and everything I'm looking at right now tells me the pressure is building to the upside. Here's the first thing you have to understand about this market. The gold to silver ratio is currently at 61.6. That means it takes 61.5 ounces of silver to buy 1 ounce of gold. Historically, when this ratio is elevated, silver has room to run. Gold has been the leader in this precious metals cycle, pulling ahead, and silver is the younger, faster sibling that always catches up eventually. And when it catches up, it tends to overshoot. A ratio at 61.6 is not screaming danger for silver. It is whispering opportunity. The compression between these two metals never lasts forever, and the unwind of that ratio historically happens fast, which is exactly why Asian buyers are not sitting on their hands waiting for the ratio to correct. They are positioning ahead of it. Now let's talk about what is actually driving this market on a fundamental level. Because if you think silver is just a shiny rock that people buy when they're scared, you are missing the entire structural story that makes this metal unlike anything else in the commodities world. 60% of all silver demand every single year is industrial. Not jewelry, not coin collectors, not preppers in bunkers. Industrial. Solar panels, electronics, electric vehicles, artificial intelligence infrastructure, data centers, all of it runs on silver. Every solar panel on every roof in every country that is trying to hit a net zero target requires silver. Solar alone accounts for 16% of total global silver demand, and that segment has been growing at 14% per year for the last decade. That growth is not slowing down, it is accelerating. Governments are mandating it, corporations are funding it, and silver is the irreplaceable conductor at the center of all of it. Add to that the electric vehicle market, which accounts for nearly 3% of global silver demand and is still in the early innings of its adoption curve. Add data centers being built at a pace the world has never seen before to support the AI infrastructure build-out. Every server, every chip, every connection point uses silver. You start to stack these demand drivers on top of each other, and what you get is a metal that the world needs more of every single year, not less. And here is the part that does not get talked about enough. The supply side of this equation is broken. The silver market has been running a structural deficit for multiple consecutive years. That means the world is consuming more silver than it is mining. Every year, consistently. Above-ground stocks are not infinite. You cannot print silver. You cannot create it with a central bank policy decision. When demand exceeds supply year after year, eventually price is the only mechanism that can rebalance the equation. That rebalancing has been happening, and it is not done. Lease rates. And this is something most retail investors never even look at, spiked to extraordinary levels during recent periods of acute stress in this market. When lease rates spike, it means physical silver is becoming harder to locate and borrow. It means the market is tight in a way that does not show up cleanly in the spot price right away. It is a leading indicator. And the fact that we saw that kind of spike recently tells you something important about the underlying physical market dynamics that are still in play right now. Then you layer in the macro environment and the picture gets even more interesting. The Federal Reserve meets on March 18th, 9 days from today. The consensus is that they hold rates steady at that meeting. No cut, no hike, status quo. But here is what matters more than what they do on the 18th. What they signal about the rest of the year. Markets are currently pricing in approximately 60 basis points of easing across 2026. That is more than 2 full quarter-point cuts expected before the year is out. Every time the Fed signals that cuts are coming, real interest rates fall. And when real interest rates fall, the opportunity cost of holding silver, which pays no yield, disappears. Silver thrives in a falling real rate environment. It always has. The setup for the back half of this year, from a rate perspective, is constructive for silver in a way that is hard to ignore. And then there is the geopolitical dimension, which in 2026 is not background noise. It is the foreground. The Israel-Iran conflict has moved from proxy skirmishes into direct military exchanges. Strikes on major population centers. That is not a situation that de-escalates quickly. Safe haven demand for precious metals does not evaporate when people are watching missiles fly across the Middle East on their phone screens at 2 in the morning. That fear capital has to go somewhere, and historically, it flows into gold and silver. Gold moves first, silver follows. Gold has been moving, silver is following. That sequence is playing out exactly as it has in every prior geopolitical stress cycle. Now let's talk about direction, because that's why you're here. You want to know where this goes next week, next month, into spring. Here is my honest read of this market right now, and I'm going to give it to you straight, without hedging it into meaninglessness. The path of least resistance for silver over the next 2 to 3 weeks is higher. The combination of Asian accumulation overnight going into this Monday, a Fed meeting in 9 days that will either confirm the dovish path or spook markets into a short-term reversal, Middle East escalation showing no signs of cooling, and a physical market that remains structurally undersupplied. All of that points toward the upper end of the 80 to 89 range being tested and potentially broken above $90 before the end of the month. The catalyst sequence I'm watching is straightforward. If the New York Open on Monday shows follow-through from Asian buying pressure and silver breaks convincingly above $87 on volume, the next technical level is 90. A clean push through 90 with the Fed providing a dovish signal on the 18th would put 95 in play by early April. That is not a fantasy. That is a price path that the structural fundamentals can support. But I am not going to sit here and tell you there is no risk on the other side, because this is silver, and silver will humble you if you get too comfortable. The algorithmic models that short-term traders use are currently flagging a possible pullback toward the high 70s. Some forecast pointing at around $78 to $79 if the buying pressure fades and the risk-off trade temporarily reverses. That scenario plays out if the Fed surprises with hawkish language on the 18th, if there is an unexpected de-escalation in the Middle East that takes safe haven demand off the table, or if a broader equity market sell-off forces leveraged traders to liquidate silver positions to cover margin calls. Any of those 3 things can push silver back toward the lower end of its range. You need to know that going in. You need to have a plan. What you should not do is let that downside scenario paralyze you from seeing the larger picture. The larger picture is that silver at $85 is still a market in a multi-year structural deficit, with industrial demand growing faster than supply, with monetary demand returning as central banks pivot toward easing, and with Asian buyers who have a much longer time horizon than the average Western retail trader setting up their positions while everyone else is asleep. The short-term algorithms are playing a different game than the physical buyers in Shanghai and Mumbai. When those 2 forces clash, historically the physical market wins. Maybe not this week, maybe not in a straight line, but it wins. This is the metal that the green energy transition cannot happen without. This is the metal that every solar panel, every EV, every AI server depends on. This is the metal that central banks and sovereign wealth funds in the East have been quietly accumulating. And this is the metal that the Western financial media will cover breathlessly the moment it makes a move loud enough for them to notice, by which point the move will already be largely done. The people who win in silver are not the ones who chase the headlines. They are the ones who understand the story before the headlines are written, who track the physical market, who watch the lease rates, who notice when Asia is buying in the dark on a Sunday night going into a Monday open. That is the edge. That has always been the edge. If this video gave you something that the mainstream financial media did not, share it with one person in your circle who is watching the silver market. Drop a comment below with your location so I can see where this is landing. And if you are not subscribed yet, do it now, because the next update is coming before the Fed meeting on the 18th, and you will want to be there for that one. The silver market is alive right now. The question is whether you are paying attention. Most people are not. That is exactly where your advantage lives.